nobody mentioned it. And so it just went by. And now I'm paying 25% more in property taxes than I would be had I known that. So that is an annual expense that is going to recur every year as I own that property, just simply because I didn't submit this stupid one-page form.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Tait Duryea is a pilot, a real estate investor, and general ambassador of financial independence. He bought his first property at age 25. He's since accrued a decade worth of both active and passive investments. Tait's been to over 45 countries. He's skippered sailboats in the Mediterranean, Aegean, and Caribbean. He's an avid surfer, skier, snowboarder, world traveler, and adventurer, and is on a personal crusade to replace his flying income with passive cash flow from real estate. He also hosts the Passive Income Pilots podcast and is the founder and CEO of Turbine Capital, a private equity firm that enables pilots and other high-income professionals to invest in real estate. Tait, welcome to the show.
Hey, Sam. Thanks for having me on. I really appreciate it.
The pleasure's mine, man. You know, the same questions I ask everybody who comes on the show. Can you quickly tell us, where did you start? Where are you now? And how did you get there?
Absolutely. So I started with that purple book, Rich Dad, Poor Dad, when I was about 12 years old, and got into the idea of financial freedom super early on, was obsessed with the idea of real estate. I've always loved the idea of passive income from real estate. And that was the plan, actually, before I even became a pilot. The flying bug kind of bit me when I was in college and went down that road. But the real estate bug never really left. And bought my first rental property when I was about 25 years old and just sort of dabbled in it for a number of years, bought some houses, bought some condos, but didn't really dive in until maybe about 5 years ago. Started buying some multifamily and then pivoted to the passive side. And I've been investing as an LP ever since, as I sort of realized that, you know, I'm a busy W-2 professional and it's a little bit more scalable and frankly, less risky to be an LP in some other people's deals who are professionals in whatever asset class that is. So that's where I'm at now.
Man, that's cool. Tell us, what do you do? You're still a pilot, right?
I am full-time.
Okay. Talk to us about that. Talk to us about maybe even what it is you're going to do today.
Yeah. So I'm a pilot for Hawaiian Airlines, and I'm also a check airman, and I teach in the simulator. And so today, after I jump off from this podcast, I'm going down to the simulator center, and I'm actually teaching in the simulator today.
What is a check airman?
A check airman is someone who there's basically two levels of instructors. There's instructor pilots and evaluator pilots. So I'm qualified to evaluate other pilots, and I can check them out on the line.
So not too terribly different than maybe what you're doing on the real estate side. I mean, you are being a check airman for the people that invest with you.
That is exactly correct. Yeah, basically, we're not the ones designing and building the airplane, right? Like the operators would be, the Boeing and Airbus of the world, right? That are actually designing the aircraft and building it and so whatnot. But we are inspecting it for airworthiness. You know, we're looking at those deals, taking a deep dive, you know, pulling the engine apart, making sure that it looks good before we go fly it. I guess the best way to put it would be before we get on it as passengers, right? As LPs.
Right. Yeah, absolutely. You're saying, hey guys, this aircraft is airworthy. Everybody get on board because, the pilot has a vested interest in making sure that everyone gets there in one piece. So
exactly.
That's
right.
That's the same thing you're doing on the investment side. That's
exactly.
That's really cool. I love that. Talk to us a little bit. I know you said you're a busy W-2. Talk to us about what it was like to get into your first investments on the passive side, but then realize that you could grow that side of your business as well by bringing other investors along.
For sure. So, originally it was sort of active in my own deals, and then I started, scaling up into some multifamily just on my own, and realized that this is anything but passive income.
What do you mean by that?
Oh yeah. I mean, for example, I did a presentation recently, and to make this point, I searched in my email for the name of my property manager for this commercial property. I had 186 emails in 6 months. When I was doing the BRRRR, right? I had a big renovation going on, and I needed all sorts of stuff back and forth with them to communicate with the lender and communicate with the contractors. And 186 emails over 6 months. And each one of those threads had multiple emails within it. I'm thinking to myself, this isn't very scalable. And this isn't a hugely beneficial use of my time. So that's when I pivoted over to the passive side. But to your question, which was, when did you go from passive investing on your own to passive investing with a group, with our fund? It was a few years ago. I met some great people around the conference circuit, one of which was Dr. Peter Kim, who has a private equity group for physicians. And he was saying, you could do something like this for pilots. And I thought to myself, gosh, there has to be someone who's doing that for airline pilots, because it's a large professional demographic who are very similar to doctors in a lot of ways. And no one was doing it. And so I sat on the idea for about a year, and I just thought, this is a really cool thing to bring to a professional demographic who traditionally has less real estate exposure than they probably should in their portfolios. And so the idea sort of simmered for a little while, and about a year, coming up on 2 years ago, I started working on it, and we launched about 5 quarters ago.
Gotcha. So you go out now to, and I think this came out of your bio there, you enable pilots and other high-income professionals to invest in real estate. How does that conversation happen? I mean, is this something where you're just sitting in the cockpit talking to other pilots going, hey, man, invest in real estate, or what's that look like?
Yeah. I mean, the name is starting to get out there, and people ask me, we'll be sitting in the cockpit and they'll say, hey, what is this? And I'll tell them, well, it's a private equity group that I put together to help guys like you invest in real estate. Now, and I'll tell people very straightforward, hey, this isn't necessarily a replacement for going out and buying your own rental property. If you have the wherewithal and the motivation and the desire to go out and buy rental property and make those deals happen, fantastic. Do that. But also look at the passive side, right? And especially for the guys who have guys and girls who have kids and busy schedules, and they're traveling and they're flying a lot. It often, a lot of parallels with, say, the doctor or attorney crowd, where, they're really good at their day job. They make great money, and it doesn't necessarily make sense to go out and spend a couple of years really kind of learning the ropes of real estate, because real estate's hard. Real estate is it's easy to kick your feet back after you've done it and talk about how great it is, but it's a slog to get a real estate investing business going, to really learn the ropes and build your network and find your market and put out offers and get deals under contract and actually do the thing, right? So if you have the motivation to do it, fantastic. But if you don't, this is a great way to get some exposure and get some really great returns without having to do anything. And then where we come in is we're going to do the vetting process for you, right? Where we have a fund, and we have a bunch of power in numbers so that we can vet these deals properly before they go to our investors. So, yeah.
Are you actually running a fund, or are you guys doing the fund of funds model?
We're doing a fund of funds model right now. We may co-GP with some operators in the future, but right now we've just done strictly fund of funds. Which is great because we've been able to get into some alternate share classes that have better return profiles. And that's essentially how my company ends up making money in the long term, is we take some of that delta between the two share classes. So essentially, if a minimum investment direct to sponsor was 50 grand with, say, a 60-40 split, and then there's an alternate share class, say a B share class, that has a 70-30 split with a $2 million minimum, we're able to pool capital, buy that B share class, and then all of us benefit from that, right? So our investors get a slightly better return than the direct to sponsor, and then we make the majority of that delta, which is great for us, and it's great for the sponsor as well, because they know that they can count on us for capital if they bring us deals that pass the muster.
That's interesting. I mean, not every sponsor is going to do that.
Correct.
Do you work that out in advance with the sponsor and say, hey guys, this is the way I want to participate, or how did that conversation really come about, and how did you end up structuring it that way so that you don't end up costing your investors money? Because one of the drawbacks to a fund of funds is now it adds additional layers of fees typically.
Right. And we don't want to, that's the drawback of the fund of funds, right? Is you're playing middleman, right? And we don't want to, I certainly don't want to be a middleman, because middlemen are disposable. You're writing yourself an end date for existence, because as the world gets more democratized and connected and transactions flow more efficiently, middlemen are going to disappear, right? So we truly want to be a win-win-win operation, right? And I think that most sponsors that I've talked to are definitely open to giving better splits to higher sums of capital, because they only have to do, if we're investing $2, $3, $5 million, we're investing as one investor, not 100. So because the entity that we're putting together is the investment entity, right? So the sponsors that I've talked to so far that I have relationships with in the business typically write in these alternate share classes from day one. If they don't, you do have to get ahead of it. You can't really negotiate that after the fact. Once it's gone out to their list, you can't really go back and say, oh, hey, by the way, we're going to write in this extra share class if you invest this much. It kind of needs to be negotiated ahead of time with whatever sponsor you're going with.
Right. Yeah, that's a great point for anybody listening to this. You might be thinking, oh, that's a really cool idea. I might be able to raise XYZ money, and then we could get an alternate share class. But you need to get ahead of that, long before legal docs have ever been drafted. Because once those are inked, once people are signing docs, I think, that ship has sailed.
Exactly. That's correct.
Okay. That's really, really fascinating. You said something earlier that I want to kind of circle back on, where when you're talking to some of your potential investors or other pilots, like, hey, if you've got the capacity to go out and buy rental property on your own, and that's what you really want to do, this may not be for you. I would disagree with that, but tell me why you say that.
Okay, so let me clarify. Certainly not saying this wouldn't be for you, just different buckets, right? There's potential, if you're buying your own real estate and you're doing it well, that you can make an infinite return on your money. That's better than a typical 15 IRR that you're seeing in the syndicated world, right? Because you're splitting those profits with the operator. The benefit is that it's in my opinion, a much lower risk profile than doing it yourself, because it's a professionally managed deal, right? So not to pick on doctors, but the Bonanza, right, is a high performance aircraft that was nicknamed the doctor killer in the 80s, because a bunch of these high earning physicians would get their pilot's license, buy a nice high performing aircraft, and they'd end up killing themselves because, they got the hang of it, but they weren't pros, and they'd get into some weather they couldn't get out of, or, they had some sort of a system malfunction or an engine failure that they didn't handle properly. And that's sort of what it's like if you're investing in real estate, in my opinion, on your own. I experienced it firsthand. When I started scaling to multifamily, I missed some things that a professional would not miss, that cost me a significant amount of money. And so while I'm making a fantastic return, cash on cash, because I did the BRRRR deal, the buy, rehab, rent, refinance, repeat, right? So I pulled most of my cash out of the deal. And when you look at the cash on cash return, it's really healthy. But, there's much higher risk in me going out as that weekend warrior and flying that small airplane versus being a passenger on a professionally flown aircraft. So that's sort of how I look at it in terms of risk reward. You have the potential to earn, 40, 50, 100 infinite % return on capital if you're doing it yourself and you're willing to put in the work and roll up your sleeves and do it. And if you're not in a W-2 profession where you're making a whole lot of money, it may be a faster way to financial freedom, right? Than being an LP. But if you're making plenty and you're busy, there's no better way. So I agree with you there.
Yeah. That's very interesting, because one of my 10-year goals, even in this business as active as I am, 10-year goal, man, I want to be 100% LP.
100%. I'm with you.
Yeah, in 10 years, it's just where I want to be, because it makes sense. I mean, I'm an LP in lots of different asset classes right now, and I'll tell you, I love every minute of it. Because a check, you see, deposit, ding, 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 and your bank account every month. You go, gosh, that was easy. I'll just keep letting that happen.
It's passive income.
Right. That's
truly passive income.
Truly. And I think to your point there, obviously it costs more money on the front end, right? Like you can leverage a single share of, most investments, let's call it 50 grand, right? That's my typical sponsor minimum. You can leverage that maybe into more real estate than you could in a passive investment and get, like you said, higher leverage on that. But either way, man, just ease of transactions, incredible.
100%. Yes.
That's really cool. Talk to us about the mistakes you said that you had made early on that maybe, if it were a professionally run syndication, they would have caught.
Yeah. So I started scaling up into some personal multifamily deals. And one in particular was in South Carolina, happens to be 6 time zones away from where I usually am here in Honolulu. And there were some little things that I missed. One was the opportunity to retrade during our contract due to some problems with the roof, which I didn't end up retrading very effectively. A professional operator probably would have done a better job of being a tough negotiator there. Another one was property tax. So I had no idea that in South Carolina, there is a one-time form that if you submit to the tax assessor's office, you get a 25% discount on your investment property taxes. And it's only submittable in the first year of ownership. My broker didn't tell me. My property manager didn't tell me. My closing attorney didn't tell me. Nobody mentioned it. And so it just went by. And now I'm paying 25% more in property taxes than I would be had I known that. So that is an annual expense that is going to recur every year as I own that property, just simply because I didn't submit this stupid one-page form. Those are the kind of things that are easy to miss as a weekend warrior, even when you're fairly well versed in the real estate industry, that a professional operator just never would have. They've got 600-point checklists and all the relationships, and they've done this day in, day out. They're pros, right? So, but that's a lesson learned. If anybody buys property in South Carolina, look for that form.
Man, absolutely. Yeah, I need to look that one up. That's it's small stuff like that. Yep. What do they say? It's the little foxes that steal the grapes. It's like,
that's right.
My gosh. That, and that's, you hate that. And that's an annual bill.
It's an annual bill.
And so you get reminded every single year, you're like, oh, there's a lot of, I could have lit that on fire and had more fun than writing. At least you got some warmth out of it. At least at this point, you're just losing money every month. That sucks. Or every year.
Exactly.
Man, those are painful lessons though, but I don't know anybody, as a sponsor. And that's one of my questions, when I'm interviewing a sponsor for me as a personal, passive investor, is tell me about a time you lost money and how did you handle it? And if they come back to me and they're like, well, we never have, it's by the end of the phone call for me. Yep. Because it's on my checklist. I've got, 100 and something questions I usually ask. And it's like, if they've never lost money, well, I don't want to put my money with somebody and be the first time they did.
Absolutely.
So kudos to you for taking it on the chin for the rest of us to, and if you're listening and own property in South Carolina, and it's been less than 12 months, go look that form up. That form up. Man, that's awesome. When you look back on, one thing we haven't talked about yet is what asset class you're in.
Great question. So I launched this company, this fund last summer. So summer of 2020. And because we were in the heart of COVID and we weren't really sure what was happening with the economy, we chose self-storage. And then to sort of throw fuel on that fire, I also had a pre-existing relationship with a fantastic self-storage sponsor. And so it made sense to raise for self-storage. Since then, it's been kind of on rinse and repeat with the storage industry. There's actually just a fantastic, hopefully Potatize can edit this out.
We can cut this out. Fantastic runway forecast.
There's a fantastic consolidation going on now in the self-storage industry, and one that's historical. It's one of these asset classes that is earlier in its maturity cycle than say multifamily. A lot of mom and pop operators out there that aggregators are coming along and putting into portfolios and rolling them up into large national portfolios that they can then sell to Blackstone, Cascade, KKR, a REIT. So a lot of opportunity there in terms of amassing large portfolios of storage and rolling it up to REITs. So we've sort of stuck with the self-storage asset class, but by no means do I want to sort of pigeonhole us as a fund into a self-storage fund. We're definitely on the hunt for about a half dozen other operators who we can marry and feel really comfortable raising for across a number of different asset classes.
That's very interesting. Does it give you any pause or any concern if there is a shift in the buying winds of the large companies that are consolidating or buying these consolidations? Is that any concern for you and where the prices of these assets may head?
Yeah, and I think the cap rates are getting a little bit ridiculous, to be frank. But we hedge our bets there by making sure that the underwriting shows expanding cap rates and conservative exits.
Gotcha. What are some of the ways that you see you guys adding value in the self-storage space? Because even if cap rates are compressing, there has to be a way where you say, hey, this is what we're going to do in order to add value to this project, and then obviously make it a more worthwhile project.
Yeah, absolutely. And again, we are simply the passengers in these deals, but the excellent aviators who are at the helm, who we've had a lot of fun working with over the last year and a half, their business plan on pretty much every project that they find is to buy facilities with vacant land. They'll spend some money initially to improve all deferred maintenance, pave drive aisles, replace doors that need replace any swing doors with roll-ups, renovate the office, new fencing, security, lighting, make it a nice place to be and that people feel safe in. From there, bump rents to market, do a lot of cross-marketing strategies with Chamber of Commerce and some different businesses in town where they can there are some cross-marketing opportunities. And then from there, really it's sort of stabilizing the business as is, getting everybody on a digital platform where things are on auto pay. They tell people, hey, can't be coming down here with cash every month. We're going to need a credit card on the app, and it's going to be on auto pay. Get rid of any delinquencies by putting a double lock on anybody who's delinquent. And then after 30 days, it's time to auction. And then from there, we move into the expansion phase. So usually we see some nice growth in cash flow over the first 12 to maybe 18 months before all the conditional use permits and construction permits get through city council. Most of that stuff is done during contract, but the wrap up is kind of done after we close. At that point, this particular sponsor has an integrated in-house construction team that will go in and they'll pour the concrete and actually build a new climate controlled facility that's within the property boundary of the whatever facility. We're focused mostly on portfolio deals so that we can spread risk. So in this current deal that we just closed out, it was 14 facilities in the Dallas area. And so they'll be going around to the various facilities that have super high market occupancy and where there's opportunity to expand the facility. At that point, lease it up, stabilize it, and sell it.
Right. So the long-term plan there is to dispose of those assets once it's all leased up and the market plan or the business plan has been executed.
That is correct. Yep.
That's interesting. Very, very cool. Tait, I've had a blast learning about you, your business, what you do. This is fun. It's been fun I know we met several years ago, and it's been a blast to watch you, no pun intended, take off in your business, Sam, and what you've been doing. You. So it's been great to catch up. Last few final questions for you. If you can help the listeners avoid just one mistake in real estate, what would it be, and how would you avoid it?
Oof, I think we covered that one with the taxes. Call your assessor. You know, if you're looking at a market, especially if you're investing out of state, call the assessor's office and just poke around. See if there's any discounts, anything you can do to get that tax bill down. Yeah, that'd be my big one. Or reassessments for that matter. Yep. I mean, yep. I know we personally, to piggyback on your topic here, we personally passed on deals because we found out that the assessor was going to hammer us. Once we close, they're going to go, oh, hey, congratulations. You just paid 3 times what we have in the books for that. So your property taxes are going up by 3 times. That's Cook County, Illinois, by the way. And we said, no, thank you. We're leaving. That's an excellent point there. Question number 2 for you. When it comes to investing in the world, what's one thing you're doing right now to make the world a better place? I'm really focused on my own professional demographic, pilots. And of course, anybody's welcome to invest with us, but I'm really focused on bringing a little bit more of a balanced overall portfolio to a professional demographic that doesn't have a whole lot of experience typically in real estate and doesn't have a whole lot of time to go out and figure out how to buy rental properties. So that's my big goal is over the next 10, 20, 30, 40 years of my career, I want to bring that to the airline pilot world. I want to make it easier for them to diversify into cash flow in real estate and potentially retire early.
Yeah, absolutely. Absolutely. That's awesome. Tait, if our listeners want to get in touch with you, what is the best way to do that?
You can head over to our website, turbinecap.com, TURBINECAP, like Turbine Capital, turbinecap.com. From there, you can sign up for a newsletter if you care to. You can also just reach out to me directly, Tait, TAIT, at turbinecap.com.
Tait, thanks so much. Have a great day.
Thanks, Sam. Appreciate it. Take care.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.